Michael Burry admits he's wrong, inflation data comes in a little bit better than expected, and jobless claims are actually rising. All these signals are telling us that buying the dip might actually be a good strategy, as the NASDAQ has just entered a bull market after closing above its 20% decline. Is this reality, or is this another fearful rally? In this video, I want to address that question along with understanding what's the next inflation catalyst we have to expect and why stocks actually are performing worse than what the indices are telling us. So to start things off, let's try to understand what's the big deal with what Michael Burry just tweeted. As you can see, he said, "I was wrong to say sell." For those of you wondering what he's referencing to a tweet he made at the end of January of this year where he said sell. It obviously threw a lot of people off into potentially selling their investments because he believed that the January rally that we all remember was so strong was just another bear market rally, and it could be a repeat of what we saw happen in 2001 and 2002. And well, what exactly happened at that time? As you can see, we had more than 5 different bear market rallies throughout the overall bear market of the tech and dot-com bubble. The market was down more than 70% from peak all the way to the trough until the bottom hit in the middle of 2002. But like I've said multiple times, there are differentiating factors between what's going on today with the S&P 500 and what happened back then. And well, as you can see, the most important one of those is the fact that the US inflation rate during the bear market of 2001 was actually trending down alongside the federal funds rate. The 2-year and 10-year yields were actually going down, and we had not seen an inversion in the 2-year curve until the middle of 2000, which ended up signaling the recession that we experienced in 2001, which obviously led to mass layoffs and more than 90% of the NASDAQ actually losing money on a bottom line basis. Instead, the situation today is completely flipped to the upside. Instead, now we're facing interest rates that are going up at a pace that we've never seen before, and inflation also starting to inflect. And this right here is why we're seeing the market relax from the massive lows that it sent in October. And it's a big reason why, unless something catastrophic breaks in the financial system, which I think has already happened with what's happened with SVB, the market has already bottomed. It's just about figuring out which companies will survive the upcoming slowdown in the economy, which right now is already starting to show signs of cracking. And this neatly brings us on to a very hotly discussed topic recently around what's been happening with the NASDAQ, which has been outperforming both the S&P 500 and the Dow Jones Index, even though the overall market and growth portfolios are actually still going down. And why do I think that's the case? Well, you can see exactly what's been going on with the ARK Innovation ETF, for example. This ETF actually did not bottom in October. Instead, it hit a new low in January of this year. And as you can see, it's actually rallied a little bit, but it's just been going sideways for the most part of this year so far. Whereas the NASDAQ has actually hit a new near-term high, resulting in it climbing more than 20% from its lows. And because the NASDAQ tracks mostly tech stocks, this has actually also resulted in the S&P 500 actually outperforming its equal weight counterpart. Now, the ticker symbol RSP is the equal weight ETF from the Invesco investment firms. And as you can see, over the past 5 years, the equal weight ETF has just underperformed the S&P 500 by around 10%, which is expected because tech stocks, which are highly weighted in the S&P 500, always tend to outperform in a bull market. But what's happened very recently over the past 1 month is that the S&P 500 has been outperforming again to the upside compared to the equal weight, even though over the past 6 months, it has performed much worse. And this is the same thing going on with the NASDAQ. As you can see, the breadth of the NASDAQ 200 is at all-time lows compared to levels we saw at the end of last year, even though the index itself is actually hitting new highs. This means around 30% of the NASDAQ's companies are actually above the 200-day moving average when the index is also above its 200-day moving average. And although I don't consider myself a market maker or a prophet, I do think there's one big reason why this could be happening. And it all revolves around the divergence of growth stocks from value stocks. As we all know, tech stocks that are unprofitable or very high growth always underperform during recessions and bear markets, because these companies tend to have the lowest moats, the highest cash burn, and typically the lowest profit margins. I'm not talking about the Microsofts or the Apples or the Nvidias, which are extremely profitable businesses that are extremely successful. I am talking about more than 75% of the NASDAQ, which right now are mostly growth companies that have yet to prove themselves. And because right now the market is all of a sudden shifting its focus from what's been going on with inflation to how the recession is going to play out at the end of this year or the start of next year, markets are rewarding those more profitable, more established businesses in this rally, which obviously are weighted towards the very top of the indices. You can clearly see that to what's been going on with the NASDAQ's PE ratio and its EPS projections. Just over the past 4 to 5 weeks, EPS projections on a forward basis have only started to tick up. And because the S&P 500 and NASDAQ's profit margins have come down really significantly since their highs, there's really high likelihood that in this rally, which is driven by the relief around inflation and potentially interest rates hitting their peak later this year, that the companies that are most likely to survive the next 12 months from a recession's point of view and return value to shareholders are the ones that are going to get rewarded by the market. And those are obviously the best of the best companies at the very top of the indices. The types of companies that I personally invest in, for example, that are unprofitable right now and extremely high growth are not the ones that are going to get rewarded by this rally. Those companies, unfortunately, are most likely going to take more time to recover as their financial management positions have to understand how they can navigate the upcoming slowdown. But buying the dip in the companies that are established is paying off, and that's really clearly being shown with how the NASDAQ and even something like Bitcoin is performing, because Bitcoin is obviously an indicator of the risk appetite of markets. And with jobless claims edging up to 198,000 in the most recent report, which is much higher than expected, there's signs in the market that companies are going to start struggling on a much wider basis. We're not going to see just big tech layoff workers, but now we're going to see mid-cap companies and potentially small-cap companies like biotechs and startups also end up laying off, which right now has actually been holding up really well up until the SVB's collapse. Because keep in mind, the 2-year yield has come down significantly from its high of around 4.9% just earlier this month. Right now, we're seeing fears of this recession really hit some of the more unprofitable companies, as clearly seen with the year-over-year analyzed percentage change in the Case-Shiller Index, which is basically the index ETF of the housing market. And clearly one of the other things that's been spooking investors is the idea around the discount window from the Federal Reserve, which just spiked higher than what it did in 2008. This is essentially credit that banks and lenders can get access to that is extremely cheap to help prevent contagion in the economic system. We saw this happen in 2020, and ironically, as you can see, it kind of coincided when the market bottomed. Now, obviously, I already think markets have bottomed, so it would actually be a very different time this time around where this discount window spiked after the overall markets bottomed, which just goes to show you how different the economic situation is today with any other scenario that we have experienced over the past 50 years. Because guess what? We have not seen a pandemic of this scale in over 100 years. What do you guys think? Is this bull market going to last, or is this just a fake out for more pressure and downside on most stocks in the market? You guys have just heard my take on the situation. Even if markets decide to go down even more, I'll be continuing to be a buyer of stocks and ETFs for the future. But as usual, let me know your thoughts down in the comment section below.